When global systems collapse, they rarely announce themselves. There is no dramatic alarm, no sudden explosion. Instead, they loosen slowly, almost invisibly, until one day the world wakes up and realizes the system it trusted is no longer there. And in 1971, that realization came not through a war or a protest, but through a quiet shift that would redefine the value of money forever. For centuries, gold had served as humanity's ultimate benchmark of value. Across continents, across empires, gold symbolized permanence. It could not be printed, negotiated, or manipulated by decree. A gold coin held in Rome carried weight in Cairo, Beijing, Istanbul, or London. It unified economies long before modern globalization existed. In times of crisis, people fled to gold. In times of stability, gold maintained the rules. Its scarcity created discipline. Its properties created trust. By the 1800s, the world formalized this trust into a structure known as the gold standard. Currencies were now backed by fixed quantities of gold, giving nations a clear framework for value. Governments couldn't print money at will because every unit of currency needed real gold behind it. Inflation stayed low, international trade flourished, and financial markets operated with a predictability that is almost unimaginable today. Money was simple and predictable, but the simplicity of gold collided with the complexity of the 20th century. 2 world wars, industrial revolutions, global reconstruction efforts, and societal changes created new demands on governments, demands that far exceeded what a metal buried in the ground could support. As World War II neared its end, global leaders understood that the world could no longer rely on dozens of disconnected national currencies. A new financial order was needed, one that could rebuild shattered economies but still preserve the discipline of gold. In 1944, representatives from 44 countries met at a hotel in Bretton Woods, New Hampshire, and designed such a system. Under this agreement, the US dollar became the centerpiece of global finance, and the United States promised that any foreign government holding dollars could exchange them for gold at a fixed price, $35 per ounce. Other currencies would be tied to the dollar, and the dollar itself would remain tied to gold. It was not the old gold standard, but a hybrid, an attempt to merge stability with modern economic scale. The reason the dollar was chosen was simple. At that time, the United States held nearly 3/4 of all the gold in the world. Its economy was strong, its industrial base untouched by war, and its political influence enormous. For many nations, trusting the dollar felt as safe as trusting gold itself. In the early years, the system worked remarkably well. Europe rebuilt, Japan recovered, international trade surged. The United States became the supplier of the world, shipping goods, machinery, and investment across continents. Dollars flowed outward, fueling global growth. But beneath this success lay a fundamental contradiction, one that would eventually bring the entire system crashing down. For the global economy to grow, the world needed more dollars in circulation. Yet every dollar was supposedly backed by a fixed amount of gold. The more dollars the U.S. sent abroad, the greater the pressure on its gold reserves. Over time, foreign governments began holding more dollars than the United States could possibly redeem in gold. This problem was known among economists as the Triffin dilemma. The world needed U.S. dollars to expand global trade, but the more dollars that circulated internationally, the weaker the U.S. ability to back those dollars with gold. The system depended on trust that redemption would never be demanded all at once. But by the late 1960s, trust began to falter. U.S. spending soared due to Cold War commitments, domestic programs, and the enormous costs of the Vietnam War. As more dollars were printed and sent abroad, countries began quietly asking themselves a dangerous question. What if the United States no longer had enough gold to back those dollars? It didn't take long before some nations stopped whispering and began acting. France openly criticized the system, arguing that the United States enjoyed an unfair privilege, being able to print a currency that the world was obligated to accept. French officials sent ships to New York Harbor to physically retrieve their gold in exchange for dollars. Other countries followed, discreetly but steadily. U.S. gold reserves, once towering, began to drain. Vaults that seemed unshakable only a decade earlier were now depleting month after month. Economists inside the government sounded the alarm. If redemptions continued at this pace, the United States would run out of gold entirely. The global financial system was unraveling quietly, behind closed doors. By 1971, the strain reached its breaking point. The United States was facing a situation where foreign governments held far more dollars than America had gold to redeem. The world had begun presenting IOUs that the U.S. could no longer honor. Confidence was cracking. Markets were unstable. Foreign exchange crises spread from country to country. On the evening of August 15, 1971, President Richard Nixon addressed the American public on television. The speech seemed calm, measured, even routine, but within it was a single sentence that would alter global finance permanently. Effective immediately, the United States was suspending the convertibility of dollars into gold. In simple terms, America would no longer allow foreign governments to exchange their dollars for gold. The promise that had defined global money since World War II was gone. With one announcement, the link between the world's reserve currency and gold was severed. Many expected panic, some predicted collapse, but instead, governments around the world adjusted. They accepted the new reality. Currencies would now float freely, rising or falling based on markets, policy decisions, and geopolitical events rather than fixed gold reserves. Money had changed, permanently. Without gold acting as an anchor, governments gained new powers and new temptations. They could stimulate economies more aggressively, print more money in times of crisis, lower interest rates to encourage growth, and intervene in markets in ways previously impossible. The financial world became more dynamic, more flexible, and undeniably more political. Over time, this flexibility contributed to both extraordinary global growth and significant volatility. It allowed nations to respond rapidly to recessions, but it also enabled periods of high inflation. It supported innovation and expansion, but also helped create credit booms, debt cycles, and speculative bubbles. The discipline once imposed by gold had been replaced by a system driven by trust in institutions, central banks, and policymakers. Some argue that abandoning gold freed the world from unnecessary constraints. Others argue it removed a vital safeguard and opened the door to financial excess. Yet regardless of perspective, one fact remains undeniable. The modern global economy, from trade to investment to monetary policy, exists because of that moment in 1971. The collapse of the gold standard was not just an economic event. It was a turning point in the story of money itself. The world moved from metal to promises, from fixed value to managed value, from a system defined by restraint to one defined by possibility. And whether we consider this evolution progress or a warning, its impact is everywhere, in every interest rate decision, every currency movement, every financial crisis, and every moment of economic stability. When gold lost its throne, a new era began. An era built not on what we can dig from the earth, but on the systems we construct, the policies we trust, and the confidence we share. Money changed forever, and the world changed with it.